There's this old idea in economics that a weak currency can pretty much fix anything. The logic seems super simple, right? Just make your country cheaper, and the investment will come pouring in. But what if one of the world's biggest economies put that exact idea to the test, and it failed spectacularly? Okay, let's get into it. And that's really the big question we're tackling today. For decades, Japan has basically been the ultimate real-world experiment for this theory. And now, the results are in. And believe me, they challenge just about everything we thought we knew about how currency and investment work. The textbook theory is pretty seductive, isn't it? I mean, it makes sense on paper. If your currency, like the yen, gets weaker, then your products, think cars, electronics, suddenly become a whole lot cheaper for people in the US or Europe to buy. And at the same time, your companies and real estate start to look like an absolute bargain to foreign investors. It really should be a win-win. But what looks good in a textbook doesn't always play out in the real world. So let's take a look at that reality. Because in Japan's case, this wasn't just some small little deviation from the theory. No, this was a full-blown, head-on collision with it. Just let that number sink in for a second. A 60% decline. We're not talking about a minor little dip here. This is a massive, multi-decade collapse. To put that in perspective, that's the kind of drop you might expect to see from a developing nation, not the third largest economy on the entire planet. So this chart here, it shows the yen's real effective exchange rate. It's basically its true value against a whole basket of other major currencies, once you account for inflation. And you can see it right there, just a steady, relentless fall since its peak way back in the mid-90s. Now, if the textbook theory were true, this graph should have been Japan's golden ticket, turning it into an unstoppable magnet for global money. But here's what was actually happening on the ground. Despite that epic currency crash, Japan's economy has been, for the most part, just stuck in neutral. GDP growth? Flat. Productivity? Stagnant. And that big boom in corporate investment that was supposed to happen? Well, it's just missing. Which leads us to the million-dollar question, right? With the entire country effectively on a massive sale for 30 years, where are all the buyers? Where's that flood of foreign investment we were promised? And the data gives us a pretty stunning answer. There was no boom. This chart shows foreign direct investment, or FDI, as a piece of Japan's GDP, and it's basically a flat line. I mean, look at it. The biggest for sale sign in modern economic history went up, and crickets. Almost nobody showed up to the party. But the paradox gets even crazier. It's not just that foreign money isn't coming in. The truly wild part is that Japanese money is rushing out. Japan's own companies, we're talking giants like Toyota, SoftBank, and Takeda, they're the ones choosing to invest billions of dollars outside of Japan, even though the weak yen makes those foreign assets way more expensive for them. So if a cheap currency doesn't automatically bring in investment, then what does? This whole puzzle forces us to look past the price tag and really ask, okay, what truly drives these massive financial decisions? And this really gets us to the heart of it. The old myth assumes investment is all about finding a bargain, that it's all driven by foreign exchange rates. But the reality is, capital, whether it's from across the street or across the ocean, it chases one thing above everything else, the prospect of a solid return. And this quote just says it all, doesn't it? You can slap a discount sticker on an asset, but if that asset is sitting inside a stagnant, no-growth economy, investors are still going to walk on by. The price just doesn't matter if there's no real potential to make money down the road. Now get this. This isn't just a Japan story. In a really fascinating twist, China is making the exact same kind of mistake, but in the complete opposite direction. It just goes to show how widespread this flawed thinking really is. So on the left, you've got Japan's currency taking a nosedive. And on the right, you can see China's, which for a decade was just skyrocketing. They're two totally opposite paths, right? But both governments are operating under the same flawed belief, that they can steer their economy just by messing with the currency. So for years, China's currency got super strong. Now that its economy is hitting some speed bumps, you'd think they'd let the yuan weaken a bit to help out. But nope. Instead, Beijing is burning through billions to prop it up, because they're terrified that if the currency falls, investors will just yank their money out of the country. They're trying to defy economic gravity. So is it working? This chart says it all. No. Despite all their efforts to look strong by keeping the currency high, foreign direct investment into China is clearly trending down. Investors see the real challenges under the surface, and they're pulling back, no matter what the currency is doing. So, after looking at Japan's plunge and China's defiance, we can pretty much boil all of this down to a new and much more accurate rule for how the world of investment really works. Here's the bottom line. A country's exchange rate, it's like a fever. It's a symptom that tells you about the health of the patient, which is the economy. Trying to fix the economy by manipulating the currency is like trying to cure an illness by just fiddling with the thermometer. You're completely missing the real problem. So the next time you hear a politician or a pundit on TV claim that a weaker currency is some kind of magic bullet, you'll know the right questions to ask. Ask them, if a cheap currency is the answer, why didn't Japan's economy boom after a 30-year sale? And ask them why Japan's own companies were leading the charge to get their money out of there. And then ask them why deep structural economic problems just don't seem to care what the exchange rate is doing. Because that's the ultimate takeaway here. Capital is smart. It flows toward opportunity and growth. A discount is nice, sure, but it's no substitute for a healthy, dynamic economy. The goal shouldn't be to become the cheapest place to invest. It should be to become the best place.